Hello, teachers, students, professors of economics. My name is Connor McCullough, and I'll be presenting on the economics of the 2008 financial crisis. The guiding question I used for this was how did the 2008 market collapse distort the economy for years to come? How is the government successful in trying to restore confidence and health? So let's get into it. So first, we will be looking at the causes of the 2008 economic crisis. So first off, we have to acknowledge that one of the main causes of the crisis was the government's shortcoming and failure to understand a common economic fallacy: correlation does not equal causation. So in terms of economic success of homeownership was where they fell short. Just because homeowners tend to be more economically stable doesn't mean that simply becoming a homeowner causes economic success. There's a lot more complexity behind that relationship, and usually economic success comes before owning the home, not vice versa, which the government fell victim to this common economic fallacy, correlation not being equal to causation. Traditionally, qualifying for a home loan required meeting pretty strict standards. You would need proof of income and employment, a strong credit history, at least 20% down payment on the house, and the borrowers were typically limited to fixed rate loans over 15, 20, or 30 years. These mortgages had interest rates that stayed the same over time, which made it a lot easier to plan monthly budgets. The idea was that homeownership came after financial stability, not before it, like I said earlier. But the government wanted to increase homeownership among lower and middle income Americans, hoping that this would lead to greater financial security for them. So they began to introduce programs aimed at helping more people qualify for mortgages, even if they didn't meet the traditional loan requirements. And this is where subprime mortgages entered the picture. A subprime mortgage is a loan given to someone who doesn't have perfect credit, or in other words, wouldn't have qualified under the traditional loan standards, which I shared on the previous slide. This made these borrowers more risky, and to compensate for the higher risk, lenders, usually banks, charge these borrowers higher interest rates. Many of these loans were adjustable rate mortgages, meaning that the interest rate could change over time, usually starting low and rising significantly. If you look at the chart on the right, you can see that from 2004 to 2006, the shape of the subprime mortgage originations grew rapidly. That's the blue bars. You can see the spike in 2004. At the same time, homeownership rates, shown by the red line, were also peaking. This shows the government's push to expand access to home ownership did work, at least in the short term. More people were buying homes, but it also meant that they were doing so under much riskier loan conditions and often without the financial stability traditionally required to sustain home ownership long term. So now that subprime mortgages were being handed out in large numbers, Wall Street saw an opportunity to profit off of these, and that's where mortgage-backed securities came into play. So what are they? In short, a mortgage-backed security is a financial product made by bundling together thousands of individual home loans, including these subprime mortgages, into one big pool. And these pools are then sliced into pieces and sold to different investors. Investors bought these mortgage-backed securities because they believed they were safe and generate steady income from all these monthly mortgage payments. As long as the homeowners kept paying, investors kept making money. The problem was that these securities were only as strong as the mortgages behind them. And by the mid 2000s, many of those mortgages were risky, high interest loans made to people with kind of shaky credit because of those subprime mortgages. Despite this growing risk, though, credit rating agencies gave many of these mortgage backed securities top ratings, AA, usually AAAs, which gave investors a false sense of security. This created a huge demand for mortgage-backed securities. It meant lenders had more incentive to keep approving more mortgages, so people would keep buying these MBSs. But it didn't stop at mortgage-backed securities. To keep the profits flowing, banks created something even more complex: a collateralized debt obligation. These took slices of different mortgage-backed securities, even the lower rated and riskier ones, and bundled them again into new products. These were then divided into tranches and sold to investors, often with deceptively high credit ratings. The demand for these CDOs fueled even more subprime lending. So there is an economic term that many economists use to understand the chaos of the 2008 financial crisis and how major players just continued to pour fire onto this problem without even realizing it. And that comes in the term circular firing squad. So understanding this, you have to understand that banks created the mortgage-backed security and they sold them to brokerage firms. The banks then lent money to the same brokerage firms that bought the mortgage-backed securities from them. And then other companies would underwrite the insurance for these mortgage-backed securities and use the CDO. So this is kind of like a whole Ponzi scheme with banks packaging and selling to the same firms and then having a derivative instrument that kind of ensures the repayment for these mortgages. So just a completely broken system there, kind of a little bit of a Ponzi scheme with all the money coming from the banks. So this system then led to a collapse in the housing prices in the United States. They fell significantly in 2008 due to a combination of factors, primarily the bursting of the housing bubble, which was fueled by subprime mortgages and the loose lending practices that we talked about. When the interest rates on these high-risk loans eventually increased, many borrowers began defaulting on these loans, leading to a surge in foreclosures and then an oversupply of homes in the market. And as we know, when you increase supply and demand doesn't change, prices are going to go down. So here's that housing market collapse I just went over in a little bit more detail. So leading up to 2007, the banks, which no longer held the mortgages they issued because of selling them in mortgage-backed securities, had little reason to care about the creditworthiness of the borrowers. So these risky loans that were usually the adjustable rate mortgages were being handed out to virtually anybody. At first, these mortgages seemed kind of affordable, but as the interest rate rose and the home prices began to fail, monthly payments jumped up and borrowers could not keep up with their payments. So many of these borrowers found themselves underwater, meaning that their homes were worth less than what they owed towards the house. So faced with this reality, many people decided it wasn't worth paying, so they just walked away or handed the keys back to the bank and defaulted on their mortgage. It didn't stop there though. The default caused chaos in the derivative market, which was heavily built on the assumption that the mortgages were going to keep being repaid. The bundles of mortgages sold as investments plummeted in value, um, and the credit default swaps and CDOs, which were supposed to insure against those losses, were proven pretty much worthless, and then the entire system collapsed at once. And now there's a liquidity crisis with banks then not having any money to hand out any loans, which kind of froze the entire economy. So now we'll go through the government's response on the economic collapse. So the immediate government response to the crisis was TARP, or the Troubled Asset Relief Program. TARP allocated $700 billion in emergency funds to stabilize the financial sector. Ironically, much of that money went to the same banks and corporations that contributed to the crisis. The goal obviously wasn't to reward failure. It was to create a bridge of liquidity and prevent the entire system from seizing up. The government used these funds to purchase the toxic assets like CDOs and mortgage-backed securities, to place a floor under the market to stop the free fall in prices that was happening. TARP helped stabilize the banking and loaning system, but it unfortunately introduced the problem of moral hazard. This was seen with the Lehman Brothers and Bear Stearns. The government bailed out Bear Stearns, but Lehman Brothers unfortunately completely went under from this financial crisis. So there was the idea that the government could choose winners and losers based off a program, but they only bailed out Bear Stearns because they were first. With the economy in a recession after the financial collapse, President Obama signed the American Recovery and Reinvestment Act in early 2009, a $787 billion stimulus package aimed at pulling the U.S. out of the Great Recession. The goals were clear: to prevent economic collapse, revive growth in the economy, and create many jobs. The outcomes were very significant. Created or saved an average of 1.6 million jobs per year through 2012 and delivered approximately 6 million job years, which is a full-time job, held for 1 year. It also increased GDP by 2 to 2.5 percentage points between late 2009 and mid-2011. But most importantly, it helped avoid a double-dip recession, which laid the foundation for a long-term recovery for the economy. While opinions were divided politically, economic data shows that the ARRA played a key role in stabilizing the post-crisis economy. So how was the $787 billion spent? The largest share, about $690 billion, went to tax cuts, with most of that relief targeting families to boost consumer spending and give the families more expendable income. The remaining funds invested in critical areas to both stimulate the economy and protect public services. These included infrastructure, like roads and bridges. This created jobs and modernized transportation to help further the economy. Education, specifically to prevent lots of teacher layoffs, to keep jobs and keep the schools functioning properly. And social safety net programs like unemployment assistance to help the families that were hit the hardest by the recession and those that lost their jobs. The broad distribution aimed to not just jumpstart the short-term growth, but to also lay groundwork for long-term recovery in the economy. One thing that's important to note is if we note back to the multiplier effect, government spending is shown to have a greater effect on adding value to the economy. But the Obama administration decided that tax cuts were going to be more effective in the short term and made more sense for the economy. There were several follow-up measures that were introduced to reinforce the recovery. These included unemployment insurance extensions, small business tax cuts, and payroll tax cuts. These all tried to put more money in the hands of both companies and workers to increase consumer spending and government and business investment. Together, the ARRA and these follow-ups boosted the economy significantly. We saw the combined policies led to a 2 to 3% increase in GDP in every quarter from late 2009 through 2012, and they created an estimated 9 million job years, so an additional 3 million from the 6 million from the ARRA by itself, which is obviously one job lasting 1 year each. The layered approach helped build momentum behind recovery and stabilize the economy after a near collapse. One thing we don't want to overlook is the positive environmental impact that ARRA had on the US economy. It kickstarted the clean energy revolution in the United States. It funded massive investments in wind and solar energy, geothermal and biofuels, electric vehicles, and even factories and research and development dedicated to green technology. Thanks to RRA funding, the U.S. wind energy production increased by 145% since 2008, and solar installations skyrocketed by over 1,200%. These are numbers based off 2014 when the articles that I was reading were written. These investments helped establish America's renewable energy sector, created green jobs, and laid the foundation for a cleaner, more sustainable economy moving forward. Like any stimulus package, but especially this one because of the magnitude of it, there are lots of political effects surrounding the ARRA and the stimulus package. From the Democratic side, although there was some push for an even larger stimulus package, which proved to be more beneficial based on many economic reports today, there was mostly strong support for the stimulus and the size of it. There was lots of emphasis on the social programs and the job retention, like we talked about before. They also wanted to make sure they focused on lots of the families in need that were affected the most and lost their jobs. But on the Republican side, there was lots of opposition to the stimulus. They viewed it as wasteful government spending, as you can see with the cartoon on the right here. There were some concerns over the national debt, but as we've seen today, that's still not much of a factor in passing stimulus bills. One important thing that the Republicans emphasized was the importance of tax cuts, not wanting to spend as much money. They argue that tax cuts for businesses and individuals would be a more effective way to stimulate the economy, which doesn't align with the multiplier effect, but that's kind of how the classical Republican theory is. And they have some skepticism on long-term effectiveness to create jobs and make sure those weren't just temporary jobs like the construction jobs that you would see on the infrastructure projects. So the key points of contention I want to go over here is that the Democrats emphasize the government action to help spur recovery and help those hit the hardest, while Republicans advocated for less government intervention, focuses on balancing the budget with tax cuts. Wrapping up shortly here, I do want to revisit the guiding question. So it's safe to say the 2008 market collapse deeply distorted the U.S. economy for years to come by triggering the severe recession, which was highlighted by widespread unemployment and long-lasting underperformance in the labor market. Millions of workers were unemployed for extended periods, and many eventually left the labor force altogether, reducing the economy's long-term potential output. So in response, the federal government attempted significant fiscal stimulus under the Obama administration, but it's ultimately smaller than what the economic conditions warranted, in part for political reasons. Um, the stimulus did have a positive short-term impact, but the effects were partially offset by deep cuts in state and local spending. Over time, the expiration of the temporary programs like the unemployment benefits and tax breaks added to longer term economic drag and taking almost a decade to fully recover from this crisis. Um, some critics, lots of right wing, argue the stimulus failed, but many economists, like Larry Summers, emphasize that the problem wasn't the fiscal policy, but a failure to do enough from the government. They argued that under the unique conditions of the post crisis economy, with high unemployment and low interest rates, well timed stimulus could have paid for itself by raising future tax revenue and preventing lasting damage to the workforce, but all the conditions weren't meant to do that. So, in summary, the government was partially successful in stabilizing the economy, but not bold enough to restore full economic health and confidence, especially as monetary policy also lagged in responding to the fading stimulus. The long shadow of the recession illustrates both the depth and the collapse of limitations of the constrained policy response. Lastly, I think it's fair we acknowledge some of the scars that were left from the 2008 collapse. It exposed significant weaknesses in financial regulation, particularly in areas like subprime mortgages, which is a lot more complex than most people could understand. There was a reform to that with the Dodd-Frank Act. It was passed to strengthen financial regulations, create oversight bodies, and reduce the risk of these systemic failures. They also established the Consumer Financial Protection Bureau. This protected consumers from unfair financial practices that were going on during the sale of these subprime mortgages and then packaging off these as financial instruments. Some more key lessons is that the financial markets are, like I said, dangerously complex. And then finally, the public lost trust in banks and in government. Many Americans felt betrayed as major financial institutions took on excessive risks and then required taxpayer funded bailouts to survive. The loss of trust in the banking system has spurred demands for a lot stronger regulations and greater accountability from these firms. And then the lack of trust in government, the government's handling of the crisis also led to significant loss of public confidence. While bailouts were necessary to stabilize the economy, many saw them as unfair, particularly since the public had to bear the cost, while the banks and the executives responsible for the crisis were largely unpunished. Only one person ended up going to jail, and that was a Swiss banker. This fueled widespread disillusionment with government institutions. Final concluding thoughts here. The swift action was necessary. The rapid implementation of programs like TARP and ARA prevented a complete collapse of the financial system. These measures demonstrated that decisive government intervention was crucial in times of severe economic distress and was mostly successful. Government bailouts were also a double-edged sword here. While bailouts were essential to stabilizing the key financial institutions, they also sparked debates about moral hazard. Critics argue that rescuing failing institutions sent the wrong message, encouraging risky behavior. And then finally, some lessons for the future. The government's response in 2008 taught us valuable lessons about the necessity of proactive regulation, timely intervention, and transparency in financial markets. These lessons continue to shape policy decisions aimed at preventing future crises, but they also remind us of the complexity and unpredictability of global economies.